Good morning. It's Tuesday, the 23rd of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, but in transit right now.
This is a core report with Govindraj Ethiraj.
Before I kick off, my episodes for the next 7 days will be intermittent and shorter as I'm away attending the conference. And now for today's take. As you read or hear this, the Union Budget Documents 2024 have been printed and will be ferried to Parliament, where the Finance Minister will present it. Now, budgets in India command more attention, including from media persons like me, than perhaps any other country in the world. Their impact, equally I would argue, over time is usually the inverse, which is that while there may be a few good things, there will also be fresh hurdles in the form of fresh tax laws or guidelines, which makes life usually more complicated for everyone, particularly small businesses. Now, while we speak of reforms, in the real world, it would appear that we've reversed course. For example, reform all through the 90s and 2000s meant lowering of tariffs, while we are increasing them now. Reform meant greater competition and reduced role for government in business. There is greater competition in some areas for sure, but government is also playing a greater role in business by staying in business, much more than in a long time. I've spoken to several tax experts in both indirect and direct tax in recent weeks. They argue for specific steps to be taken in areas, but also say that all their clients are pleading for simpler tax regimes and consistency in policy and laws. Think angel tax, a law that should have been thrown out, but instead has got more and more complex and onerous, even as it has tried to create exemptions. Angel tax is all about taxing investments that are made in companies and treating them as income. The approach to hang on to laws and keep writing fresh guidelines around, and in addition to them, increases the tax compliance effort for taxpayers, again, particularly small ones who are the worst affected. India is not receiving foreign direct investment like before. Many investors are getting out since their time as venture capitalists or private equity players, for example, has also run out. Which means that while this money is welcome, was not long-term investment in the nature of hard ground-based investment, but this is not a discriminate against such short-term investment either. The Reserve Bank of India in its annual report for 23-24 says that the net foreign direct investment inflows fell to about $10 billion during 23-24 from about $28 billion the previous year. Net foreign direct investment flows were lower because of a rise in repatriation of FDI, that's foreign direct investment, from India. FDI inflow for last year decreased by approximately 3.5% the previous year, from $46 billion to about $44 billion, according to Reserve Bank of India data. And I'll come back to FDI and some of its interesting nuances in a bit. I glanced through the highlights of the Economic Survey, an annual document presented by the government ahead of the Union Budget to review the state of the economy. It provides an overview of the short to medium-term prospects of the economy. Overall, I think the Economic Survey presented on Monday was a fairly frank and fair assessment with some critical views. Economic surveys do not necessarily translate into policy action, but the independence of views is a welcome sign, which in my mind at least was not so visible in recent years. Now, there are useful recaps, including the management of inflation, where there is acknowledgement that unless we invest more in supply chains and storage, food prices and thus food inflation will keep haunting us. And if food inflation is high, so is overall inflation. One good news that the Economic Survey also speaks of is the private sector's role in more private investment, thanks in turn to strong balance sheets. To what extent that will, of course, happen is a question mark. The survey also speaks of the China plus one factor and rightly points out that it is not a given that manufacturing will automatically move to India. Put differently, the Economic Survey also reflects to some extent what industry and objective viewers have been saying across various aspects of the economy. Elsewhere, it's a fact that household capital formation is growing sharply, as evidenced by the sheer supply and demand of real estate stock. Around business, the survey makes a key point, which is that focus must turn to bottom-up reform and strengthening the plumbing of governance so that further growth can follow. There is also a recognition of the fact that small enterprises will have a greater role to play. Now, this is not a new recognition, to be fair, but I'm getting a sense that there is definitely greater acceptance of the role of small enterprises and ensuring that laws are framed for their benefit first. India's market capitalization to GDP ratio, also known as the Buffett indicator, is now blinking red, which means that market cap is way higher than GDP than it should be. The report also warned investors that a rising market cap to GDP ratio is not necessarily a sign of economic advancement or sophistication. So this is not a criticism, but at least a mild objectivity that one would like to see in an economic survey, and one is seeing it. There is fresh recognition of the fact that derivatives trading is now crossing levels that are past dangerous, and we must do something about it. As we've argued about this here, overexposure to speculative trading is not just a systems problem, as market systems in India are actually well secured to handle sudden, or for that matter, even large falls or rises. Governments also have to think of the social aspect of it, as they have been for some time now, to their credit. When young people borrow money and invest in derivatives or crypto, they're creating stress for themselves and their families, which makes it a social problem. The economic survey also says that financial assets are claims on real goods and services. If equity markets' claims on the real economy are excessively high, it is a harbinger of market instability rather than market resilience. Well put, I would say. The economic survey is prepared by the Economic Division of the Department of Economic Affairs in the Ministry of Finance under the supervision of the Chief Economic Advisor. Also, to its credit, the survey spends a fair amount of time and space on climate, assessing it, including the fact that the global pursuit of energy-guzzling technologies such as artificial intelligence and mining rare earth minerals in large quantities have only contributed to higher fossil fuel consumption. And this is directly at odds with the stated objectives of climate change mitigation. And finally, jobs. The economic survey says India's labor market indicators have improved in the last 6 years, with the unemployment rate declining to 3.2% in 22-23. The economic survey, which says that India's GDP is expected to grow at 6.5 to 7% this year, which, by the way, is a little lower than what the Reserve Bank of India is saying, though also aligns with the 7% forecast by other agencies like the International Monetary Fund and the Asian Development Bank. Coming back to jobs, the net payroll additions under the Employees Provident Fund have more than doubled in the past 5 years. This usually signals an increase in formal employment, and this is what the economic survey is claiming as well. Now, these figures are, of course, not fully representative, since there is some confusion now on which data sets to believe, and there are not too many in any case. Jobs are, of course, not a new problem, and it is not fair, perhaps, to blame the federal government entirely. Because in the same decade, as say job creation has slowed in some states in the country or not really picked up, it has done so in other parts. This is, of course, linked to private investment and the ease of putting up a factory or some other venture, and, of course, the existing ecosystem, let's say information technology in Bangalore, Hyderabad, Chennai, or Pune, and Delhi, or automotive in Pune, Chennai, Delhi, and now Gujarat. But you can see politicians reacting to this problem, and there are many more such examples. And finally, the chief economic advisor said that households were investing more in financial assets and their market value was not captured in the national income data. He was trying to respond to the point that households are in distress by saying that households are not in distress because they're investing in financial assets, and the savings in physical assets have also improved and gone from about 11% 2 years ago to about 12 or 13% rather in 22-23. So obviously a lot of people have moved to financial markets now. That's a good thing in a way, but it's also a little tricky because value of financial market savings can go up and down. And moving on to the top news of the day, markets price in budget positives. The positive aspects of the union budget are well priced in already into the sensex. The question is, of course, if any surprises will come, particularly on the tax front. Let's see. Meanwhile, the indices ended lower for the second consecutive day on July 22nd as the markets turned cautious. The sensex was down about 80 points at 80,525. The nifty was down 21 points at 24,509. The market was dragged down by Reliance Industries and Wipro after they posted weaker than expected quarterly results. We talked about Reliance yesterday. With volatility rising a day ahead of the budget, Reuters said, also referring to suggestions that a long-term capital gain on equities could be raised. The rationale for these changes may be to create an even playing field between asset classes, Axis Bank said in a note put out last week, which we referred to as well. So, just to recap, in India, gains on listed shares are taxed at 10% if you hold the stocks for more than a year or 12 months, and at 15% if it's less than 12 months. So if you sell within a year, you pay 15% tax on the capital gain that you have made or the profit you've earned. And if it's more than a year, then you pay 10%. But other asset classes, such as debt, have higher long-term capital gains tax of 20%. Why some car companies are pulling back. We spoke of foreign direct investment earlier. One area where India has seen considerable direct investment is automotive and continues to, including in the area of electric vehicles. But we're also seeing some companies pull out or want to dilute their presence. Sticking to automotive, General Motors and Ford, for example, have pulled out from India for various reasons, including internal, while Skoda India has just said it wants to look at bringing in an Indian partner. The Korean and Japanese companies, apart from the premium German cars like BMW, Mercedes, and Audi, are of course still going strong, even as newer ones in the electric space are yet to arrive. Why is Skoda wanting to pull out? Well, the answer is not clear to me, since Skoda seems to have been around for some time now, and it is not clear what an Indian partner would bring apart from, of course, capital. Now, this also tells us that foreign direct investment is a little more nuanced now, driven by specific opportunities where they come and not where they do not. There is, I guess, a problem of being a relatively mature market. I reached out to BVR Subbu, former director of Hyundai Motor India, which itself is looking at a mega initial public offer in India now worth about $2 billion, and also reflecting its continued focus on India, possibly strengthening its roots and raising capital at the same time. That's Hyundai in India for you. I began by asking Mr. Subbu what could be driving companies like Skoda after so many years to consider bringing in a partner, and what that meant for the larger automotive space and by inference, foreign direct investment.
After 20 odd years, or was it 20 or 22, 23 years, getting to a 3-4% market share, I wouldn't even call it unsuccessful. So that's one way of looking at it. But having said that, what went wrong with them? I think, if you see their start, they didn't really come in with a real commitment to the Indian market. You won't have forgotten this, I'm sure. But if you remember, Skoda started off from a warehouse of Siemens in Aurangabad. Now, that's not what you really call a commitment to a marketplace. Contrast this with the way Volkswagen went into the Chinese market. So it is really a question of that. Then, did they put their best foot forward in India? No, I don't believe they did. If you look at it, in one way, what they really did was, I don't think they brought in their best people into the Indian project. Now, when that happens, when you bring in your second or third rung of people into the Indian market, they then start selecting people who would fit their kind of, their level of people acceptable to them. So then you would have an even lower level of Indian employees joining the organization. So then these people who come in are unable to question or actually contribute in terms of strategic thinking to the companies. Now, that kind of a thing is where it all starts. And then you start with the thing saying, I want to test it out, rather than making a bold decision. And then you make up, things like this. I think this whole thing is, inevitable, I thought, the way they've gone about it. You bring in your products, you don't bring in your best products. You bring in products that, you have phased out of the other markets. Is that the way to win a market? I don't think so.
I'll come back to the product question in a moment, but the issue here is also that at this point of time, they're looking for domestic partners, or seemingly looking for domestic partners, or trying to, let's say, de-risk to some extent. So what explains that? I mean, so the past is one part, and at where we are right now.
Many years ago, I think it's in 2006, I met with the Fiat bosses, the top two people in Fiat. They were looking at, the position of trying to get in PE funding and an Indian team to help them out with the Indian thing. At that time, they had this option of looking at a PE help kind of an Indian funding operation, or joining up with the Tatas. I remember telling them very categorically in so many words, that would be the kiss of death. And that's exactly what it turned out. I mean, I said it in writing to them, actually. And that's exactly what it turned out. I mean, so if Volkswagen looks at an Indian partnership today, an existing Indian automotive player, I think it would be the kiss of death for them. So what should they rather do? I would say they should, if they have the thing, they have the commitment to India, let them go public in India, let them create a first-rate, high global quality management team in India. I say global quality management team, and then try and attack the Indian market again and to take it on again. It would mean consistency in terms of bringing in the latest technologies into India. It would mean consistency in terms of their, using India as an export base and so on. I think if they have both these and then they bring it in, that would be the better option.
So the search for an Indian partner, very specifically, means what? Does it mean that the Indian partner, if there is a partner as opposed to plain capital, will provide some way of securing or, let's say, strengthening the hold on the Indian market, which the existing company is not able to, or some legacy knowledge?
What is the knowledge of the company? The company's knowledge is in its people. A company is just agglomeration of people ultimately. So if you take the best quality of people and then put them together, and you have the Volkswagen doesn't have any requirement for capital, it doesn't have any requirement for technology. What it has to understand is how to talk to the communicate with the Indian consumer. I expect that, that is where they haven't really learned how to do things. If in 22 years you can't learn it, I don't think you're going to learn it, again. So, may as well decide that you want to bring in a different bunch of people, bring concepts like ESOPs and stuff like this, and then start building an organization.
And the other question is, obviously, of course, they are best positioned to answer it, but we've seen exits, let's say, from companies like General Motors and Ford. So is this just an intermediate step to saying that, okay, we may have got out completely, but things are not so bad. So maybe if we de-risk our portfolio by having a local partner, things could improve?
I think for Volkswagen has done reasonably well on the export front. And I believe they can continue to do so. And if they look at India as a right-hand vehicle manufacturing base, I expect they will actually be able to do something significant in India. The question is really, do they know how? I don't believe they know how. That's a problem. It's not that you don't know what to do and so on. They don't know how to do it.
And you feel an Indian player, there are only a handful of Indian players in automotive. So there's Mahindra, there's Tatas. So you feel that they could provide that missing element for a company like Skoda?
Why would they provide? I mean, what did Fiat get from Tata that Fiat didn't have? And Fiat was left with nothing ultimately. Let's look at it. Let's just see where Stellantis is today. Let's see what Jeep brand is today. I mean, you have your answers there. I don't think it's going to do very much for them to bring in any X or Y partner. I think they have to bite the bullet, go it alone, and to look at the company very differently.
Right. Now, if you were to look at the Hyundai example, company that at this point is definitely much better entrenched in the Indian market than many other international players, at least in the small segment, small and mid segment. What are the one or two takeaways on, let's say, the in a broad sense over time, which perhaps illustrate why others have not succeeded?
I think, Govind, you have seen Hyundai since the, early days of Hyundai. Hyundai put its money where its mouth was. It built global scale capacities in India. It built scale that would enable it to have cost competitiveness against Tata Motors and Maruti. It then went out into the marketplace with a product that met Indian consumers' requirements and communicated exceedingly well to the consumers through its interaction with the media on the one side and through advertising on the other side. A combination of the two actually kind of built up the brand. And then it kept a focus, a razor sharp focus on quality and customer service. I think that's something that Volkswagen, for instance, hasn't learned. Fiat never learned. So as Ford was good at it, I'm surprised that Ford threw in the towel so fast, so quickly. But I think in Ford's case, it was slightly different. I think in Ford, for instance, in Ford's case, I think the way they costed their products and they added on head office overheads to Indian operations, I think kind of killed the Indian project financially. Otherwise, okay, they were middling. They were not going any great. They were not doing any great things, but they were at least a competent company. I can't say that for GM.
Right. Last question. So Hyundai Motor has indicated that it wants to go IPO and raise almost $2 billion here, and also making it one of the largest IPOs. Volkswagen could do the same thing in India, but that also represents a certain step forward because you're locking yourself in a way to the market in a much tighter way than perhaps you were before. So how are you seeing these moves?
I think this brings me back. Many years ago, Hyundai tried to actually sell its Hyundai India was trying to sell its stakes to AIG and the Unit Trust of India, and that was the time where one of the conditions that both AIG and UTI actually put in place were that they would like the Indian management team to actually have a very clearly defined involvement, and should I even say even ESOPs and concepts and a stake to be put into the thing. And I think that would be critical. Now, if Volkswagen is told the same thing by its investors, I don't know if Volkswagen would be able to. I don't know the Volkswagen people. I've interviewed a few of them for other jobs, etc. I don't believe they would have an Indian management team that would stand up to scrutiny of investors. This is, I know it's a very drastic comment to make, but I believe that that's the truth. You've known me long enough to know that you can't accuse me of diplomacy as being one of my great vices. So you have to say it as it is, So that's where I think it goes. They have to do something really smart. And, just bringing in someone who's worked in Germany with them for 20 years and, bringing him here, he's not going to work. I mean, just because he's another Indian face out, that's not what you need. You need someone who understands India. You need someone who understands how India operates, how Indian consumers think, how Indian consumers will think in the future. That's the critical thing. So they can do it. Of course they can. I would say that would be the best solution for them because, this is not a market that they should exit ultimately. And I'm sure they know it very well.
Right. Subbu, thank you so much for joining me.
Pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.